Hey everyone, Jeff Dorman, CIO of Arca, back again for another edition of That's Our Two Satoshis Live, where we talk about everything happening in the digital asset market, as we have every week for over 7 years now. Uh, a lot going on in crypto, obviously, the last really all year, but especially heating up in the last few months. Everything from what's happening in the macro outlook in the Federal Reserve to behind the scenes in Washington and some of the regulatory updates to just updates and announcements coming from some of these digital asset companies and projects themselves. So it's been a very busy time for us on the desk here, investing in this space, as I'm sure it is for everyone at home listening. But mostly last week was really a kind of a macro story. You could argue this week maybe as well, given that Nvidia earnings are coming tomorrow. But last week, certainly everyone was watching Jackson Hole, gearing up for what Powell was going to say in his final Jackson Hole address as federal chairman. It didn't take long. We were less than a minute into his speech, and markets just shot up like a cannon, both in the equity market and the crypto market on Friday. Jury's still out on whether he was actually intentionally dovish or not, but the market certainly took it that way. Pretty much made it pretty well known that the Fed was going to start cutting rates in September. So if you look at the CME tool, the Fed Watch tool, prior to Jackson Hole, about a week and a half ago, odds of a September rate cut were around 96%. That fell over the course of the week leading up to Jackson Hole to around 70% due to some spikes in inflation metrics. And now they're back up to 88% odds of a September rate cut after Powell spoke on Friday. So pretty clearly setting the stage for rates to come down. Obviously, there's a lot of debate then in terms of, well, is that good for markets or not? And we've talked about this in the past. The last rate cut that the Fed implemented was back right before the election last year. And we talked about a lot of it at the time that there's been some mixed results with regard to rate cuts and what it means for markets. Obviously, this is more relative to the equity market than crypto because crypto hasn't been around that long. But if you go back to 2001 and 2008, rate cuts were really bad for markets. And that's because we were entering into a recession, almost a depression in 2008. And when you are cutting rates to stave off of a recession, at that point, it's too late. That's when you hear all this adage that the Fed is acting too slowly. They're too late. That was historically bad for markets because, again, this was very defensive rate cutting. But there have been other times in history where the rate cuts were not happening in recessionary times and have been incredibly bullish. This most notably in 1995, 1998, 2019, and again last year. There's also data that anytime the Fed cuts after a 6-month or longer pause, it's incredibly bullish for markets, meaning basically what you want to do in terms of interpreting rate cuts is you just don't want these panic cuts when it's happening all at once very quickly. Because again, those are happening when bad things are happening in the economy, high unemployment or mortgage related defaults or massive corporate earnings leading to bankruptcies. When you have really bad news that leads to rate cuts, that's when you get a really bad reaction. When you have rate cuts that are slow and methodical and over the course of longer periods of time, and they're really just based on the fact that they're resetting the neutral rate, those have historically been very bullish. And that's obviously what's happening today, given that you have stocks at all-time highs, you have gold at all-time highs, Bitcoin at all-time highs, employment is fine. There's really just nothing market-related that is causing these rate cuts other than the inflationary pressures kind of subsiding and trying to get the housing market back on track. So in my opinion, the markets got it right on Friday when they shot out like a cannon. Clearly, there's a lot of shorts built up in the market, especially in ETH and SOL and crypto land. But to get a 10 to 20% spike in ETH and SOL and some of the SOL and ETH based DeFi, even some of the crypto equities went higher. Probably the most hilarious of them was Circle going higher because Circle is actually one that is negatively affected by lower rates, given that 100% of their income is driven by the float that they earn on the cash. So it makes no sense for Circle to have gone up. But it just shows you where some of these shorts were built up. A lot of liquidations. In fact, we're seeing liquidations both ways over the last couple of months. Long liquidations, short liquidations. In fact, just yesterday being Monday, massive long liquidations as ETH and SOL fell 10% or more. So we're seeing a much more volatility here into the last few weeks of August and hopefully post Labor Day and into that rate cut that's expected on September 17th. But again, if you zoom out, it's hard to be anything other than bullish on markets right now. I mean, most of the bearish cases are just valuations in equities are too high, or crypto historically goes up and then comes back down. There's not a lot of teeth in that argument for why things should go lower, other than what goes up must come down. If you actually look at everything else that's happening in markets, from earnings to employment to especially here in crypto, some of the regulatory improvements and some of the partnerships that are being driven by both TradFi and the White House. Again, it's I don't know how you can make an argument right now for anything other than being long risk, especially if you're going to start seeing rate cuts and probably ultimately the printing of money again. So, our opinion has always been valuations alone don't cause crashes. You need a trigger for a crash that then can be exacerbated if things are trading at high valuations. But you don't just cause a crash based on high valuations alone. And all the people that are bared up right now and shorting the market, I think are missing the boat on that. I also think that they're missing the boat on the fact that demographics and dynamics of investing have changed a lot over the last 20 and 30 years as well. So anybody anchoring to, like a 16 PE ratio or something that has historically been accurate, they're not taking into account that stocks are just way easier to buy now than they used to be. I mean, 30 years ago, if you had any disposable income, you bought a house. It was hard to invest in stocks. You had to, go through a lot of hoops to get a brokerage account. You had to call a broker to make a trade. Now everybody has access to stocks. My 12-year-old son has a Robinhood account that he's trading on frequently. So the democratized access to stocks and crypto via Robinhood and other do-it-yourself brokerages, plus a completely unaffordable housing market, has led to the death of the American in terms of just owning a house and building your wealth that way. And it means anchoring to any historical valuations is just a fool's errand. And I think there's too many, largely older demographic investors who just don't understand how much money is chasing stocks and crypto right now that wasn't there before. And also, I would just say that anybody who is looking at the market breadth of the equity market, looking at how the bulk of the returns are being driven by the Mag 7 and a few other tech stocks, they're failing to recognize that, yes, prices have gone crazy in the stocks of those companies, but so have earnings, right? Profit margins among tech companies are some of the largest in the market, and their earnings are far outpacing the price of these stocks. So again, it doesn't mean that eventually these prices may not, they may or may not come down eventually, but it's not going to happen because of rate cuts. It's not going to happen because valuations are high. It's going to have some external trigger, whether that be a war or another pandemic or something. Something has to shock the system for this to break. And I just don't see that happening given the tailwinds that we're seeing right now. And when you look at crypto specifically, not only do you have all these positive tailwinds, but you have such an underinvestments from the majority of the world's wealth. Right. According to a recent Morgan Stanley survey, the percentage of people they surveyed who do not own any crypto has actually increased in the last year from 69% to 82%. A recent B of A survey states that 75% of their clients have no allocation to crypto at all. So you put all this together and you're like, okay, you get every tailwind imaginable for investing. You've got everything, all the support you need in Washington and in the regulatory world with regard to crypto, combined with the fact that nobody owns this stuff yet. And you've got real partnerships left and right with, again, Wall Street banks, the White House, tech companies. Yeah, to me, this is just a big pile of cash waiting to be deployed into crypto. And I think the reaction we saw last Friday was a good indication of just what's to come anytime you get any positive news. So we'll see if that holds as we head into the fourth quarter here. Historically, the fourth quarter has been mixed with regard to crypto pricing. But personally, we think this is as good of a time to invest in crypto as we've seen really in the last 7 years. And we're making our investments accordingly. So that's it for this week. We'll be back next week. We'll see what kind of news comes our way. For those who like to read the blog and see all the charts and data that's supporting our argument, you can go to our website, ar.ca/blog, titled What Rate Cuts Could Mean for Crypto and Stocks. And we'll be back again next week. Thanks, everybody.